Hello and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm joined today by Tom Hibbert from our Chief Investment Office.
Morning, everyone.
Morning,
Great to be here.
Nice to see you. So as our regular listeners will know, this is based on our weekly markets review, which we email out to subscribers on a Monday every week. But the podcast is here to be a little bit more bite-sized, to demystify what's going on in hopefully a simple and easy to understand way and give you greater confidence to invest in your financial future. So if you like what you're hearing, don't forget to hit follow on Spotify or Apple and you'll never miss an episode. This week on to a really interesting subject.
Particularly interesting one today, isn't it?
Yeah, it's a meaty one today. So grab your coffee, listen in for about the next 10 minutes. This week's meaty subject matter is all about AI, because that's one of our key themes we seem to talk about regularly on the podcast. Over the last month or so, we've talked about AI, we've talked about private credit, shadow banking. And I said at the time, it reminded me of The Big Short and that amazing movie where Christian Bale played Michael Burry, who was the founder of Scion Capital. And funnily enough, he's back in the news this week. So I'm wondering whether I also have extraordinary foresight like he did. So he has made the headlines again because he has announced he's going to close his fund and return capital to investors. And there's quite an interesting debate around why he's doing that and what that really means. So here is Tom to explain to me in a little bit more detail. So first of all, can you just give us a little bit of background to that and what's going on?
Yeah, sure. So the topic is less about him closing the fund and more about his recent positioning. So I think he's going to continue investing, but investing his own wealth as a family office. But Michael Burry, most listeners will know him from The Big Short. He runs this hedge fund called Scion Capital, which he's closing. But over the past year, and particularly in the last couple of weeks, he's been very vocal about what he sees as basically an AI bubble, which is driven by overly generous assumptions sitting behind some of the accounting of those AI companies. So he's put big short positions on some of the AI leaders.
Short positions, explain that to us first of all.
So he's betting on the AI bubble bursting, what he thinks is an AI bubble bursting.
Okay.
And he's only risking $10 million of capital.
Only.
But in the off chance that this trade works, he could make a vast profit.
Right.
Like he did by predicting the housing bubble bursting in the run-up to the global financial crisis. So although he's risking a small amount of capital, there's a potential for a very big gain if the market really does collapse. So we've spoken on the podcast about some of the very large numbers in terms of the CapEx, capital expenditure in the AI space. Yeah. And it's his observations there that are sparking quite an interesting debate.
Yes, so I think we talked a couple of weeks ago about big tech looking at investing, was it $400 billion this year in capital expenditure on...
Yeah.
I remember talking to John and we were talking about data centers and cloud infrastructure and stuff like that. So what's happening here, that investment?
Sure. So $500 billion expected next year. $1 trillion over 5 years of these mega cap tech companies.
Enormous numbers.
Huge. And the prevailing mindset in parts of the industry is that basically it's this mega race for AI. It's a winners take all game. Okay. So it's not just between companies, actually. It's also between geopolitical blocks like the US and China. Yeah. The administrations are really chasing general intelligence. It's an arms race to get the first to get to general intelligence because the pace of innovation is so great. So it creates a very high stakes sort of arms race dynamic. And you have hundreds of billions, trillions flowing into extremely expensive and rapidly advancing chips, GPUs.
GPUs, what's that stand for?
Graphic processing units, but microchips.
Okay.
And then the data center build out, obviously, around that as well. So these aren't slow sort of utility style assets. The upgrade cycle, the innovation cycle is incredibly fast. NVIDIA now has a 1-year product cycle.
Okay.
And the scale of improvement in each of those cycles, the improvement in compute power is vast.
Okay, interesting. So that high stakes arms race, whether it's companies or continents. Okay, so looping back to Burry, what are his concerns then?
Sure. So I suppose his concerns aren't that AI won't be transformational. Right? It almost certainly will.
Yeah.
It's more about some of the accounting treatments that they're using around the useful life assumptions of those chips. Basically, on their balance sheet, if they depreciate them over more years than their economic useful life,
Right.
It'll flatter near-term profits. So, for example, if a company buys $100 billion of GPUs with in reality a 1-year useful economic life, and they depreciate it on their balance sheet over 2 years, then they will be, magically inflating their earnings by $50 billion.
Okay.
And, if the real replacement cost, the replacement cycle is much shorter, then the ongoing costs are higher. And, because new chips make older ones less competitive, then today's earnings will be being pulled forward from future earnings. And that's the risk, I suppose. So it's less about the technology failing and more about whether the profitability metrics are being exaggerated by aggressive accounting.
Okay. So and whether the
assumptions.
accounting is matching the life cycle of a chip.
Yeah, exactly. So Burry's
Okay.
concern is, why are you extending the assumed useful economic life of chips when innovation cycles are
getting shorter as
much
well.
shorter?
Yeah.
There are credible arguments from these companies about why, about why they're doing that. So they're repurposing older chips and moving them into lower intensity tasks. But the simple truth is no one really knows yet what the actual true shelf life of these assets is going to be, because the technology curve is so steep.
Okay. So I can see why he is flagging that as an issue, and good that he's raising the topic and people are starting to talk about it, I guess. So thinking back then, what were people doing?
What are the actual assumptions,
Yeah.
I suppose? Yeah. I mean, I said that they're assuming 1 and 2. It was a simplified example. In reality, the useful life or the depreciation schedules that they've used have gone from sort of 3 to 4 years to 5 to 6 years.
Okay.
The logic on their side, as I said, is that those chips don't immediately become worthless once they're no longer cutting edge. They're shifted into lower intensity things, and then the longer economic life is valid. But there's also a global shortage of chips, so every single chip is being used to its maximum extent.
Yeah.
Which then there is evidence as well of strong resale demand in the secondary market. So there are good reasons. And at the same time, corporates need to be really careful about the accounting assumptions that they use. They need to have a very good argument to explain to their auditors, for example, about how they get to those conclusions. How do they get to their accounting principles? Analysts who cover the stocks obviously understand how accounting works. So they often look at cash flows rather than sort of earnings, which can be manipulated quite easily. It's not like the wool is being pulled over the entire industry's eyes. It's just the questions, as I say, are about why are these depreciation cycles being extended? Is there a risk here that it's aggressive accounting rather than the actual extension of useful economic life of these chips?
But I guess the truth is it's difficult to know exactly what's going to happen in the years ahead.
Yeah, exactly.
Yeah.
It's very much an open debate. No one really knows. Even the experts don't know what the future holds and how fast moving this industry is going to continue to go.
So just in the interest of time, let me just quickly sum up what's in my Canaccord takeaway coffee cup this week. We are talking about The Big Short, the scion of that industry, Michael Burry. And AI remains one of the most powerful and well-funded investment themes globally. But now there's this debate kicking around about how it's capitalized and how it's accounted for. Less about whether AI will have an impact on the world going forward, because undoubtedly it will, but more about how people are accounting for it and accounting for CapEx into it going forward. Should we be concerned about that?
Yeah, it's quite a technical accounting thing that sort of, you have to get into the weeds to understand where the risks come from. And that's often the case in these financial market instances. So
interesting times as ever. Thank
Absolutely.
you very much for your
Thank you.
time. I hope you enjoyed the Coffee Break podcast. Don't forget to hit follow so you never miss an episode, Tom. Hope you're following us. And any thoughts, please do share them with us, coffeebreak@canaccord.com. Thank you very much.
Thank you for listening, everyone.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.